service. Okay, it's known as form of financial inclusion. So the first one is the voluntary exclusion. So voluntary exclusion refers to the segment of population, okay, that choose not to use financial services. Okay, so they are the one who pick the option. So they do not choose to choose financial services either because they don't need those services. Okay, why? Due to a lack of promising project, or due to the lack of return from the investment. Okay, or because of the cultural or religious reason uh, that they are because of the culture or religious reason that are block them from using the financial services. Okay, and secondly, is involuntary exclusions. Okay, so on the other hand, some individuals or firms, okay, they may involuntarily exclude themselves because they have lack sufficient of income. Okay, or they have high risk profile. For example, maybe in previously they are not able to pay the debt. Okay, so they are considered as the high risk borrower. Okay, and then the other reason include the discrimination, lack of information, weak contract, enforcement, and then product features, and then price barriers due to the market. Okay. So what I can say here, so the recent statistic have estimates that based on the World Bank Islamic Development Global Report, okay, in 2016, it shows that approximately about 9%, okay, so 9% of the population across 35 selected Muslim majority countries exclude themselves from financial system due to religious reason. So this, for example, they may feel that the financial system that they have around them maybe is not Sharia compliant enough. Okay, or maybe there are no Islamic financial service around them. Okay, so with in this regard, Islamic finance actually plays a important role. Okay, to play in helping to address the needs of the world's Muslim population for the Sharia compliant product. Okay, okay, and then okay, this is the important part. Okay, so with regard the previous statistic, okay, Islamic finance basically has significant role to promote inclusive financial system. Okay, so Islamic finance actually may helps to diversify the sources of the finance for household or for business. Okay, so at the same time, they can widen up the range of the product and services and they can widen up the product and services available at the market. Okay, and then they can differently they can compete, okay, with the conventional market. Okay, there is one study, okay, that found that the Islamic finance actually might not only enhance financial inclusions, but actually, okay, it can trigger financial migration. Means that people might change, okay, their preference. Previously they may use conventional system, but by looking at the financial inclusion, they may change their preference to the Islamic finance. Okay, so what is actually the role of Islamic finance in financial inclusion? So they are basically two. So Islamic finance address this financial inclusion in two unique way. The first one is through the promotion of a risk sharing contract, okay, that basically provide the alternative to the conventional debt based financing. Okay, sebab because as we know, in the conventional finance system, normally they will rely on debt financing. Okay, so here normally the promotion of a risk sharing contract is done through Islamic bank, through the microfinance, through micro takaful, and also small medium enterprise. Okay, and then secondly, through specific instruments, okay, of wealth redistribution in the society, such as through zakat, sadaqah, and wakaf. Okay, so this is therefore actually it is a part of the Islamic social finance. Okay, now this is the example or what we can say is the risk sharing contract that can be applied, okay, in Islamic finance in order to promote financial inclusion. So we have, I'm sure you are very familiar with this term. So we have murabahah, we have ijarah, okay, we have istisna, we have mudarabah, and also musyarakah, okay. So in principles, actually Islamic financials, okay, based on this contract, okay, in principle, basically Islamic financials will make a decision, okay, based on the value of the asset and the project, okay, not the credit worthiness of the borrower. Okay, so I think I don't have to I don't have to explain one by one the definition of this contract. Okay. Okay, next. Okay, so this is the example of the Islamic social finance, which come from the redistribution of wealth. Okay, so normally we have four types of Islamic social finance. So we have zakat, we have wakaf, we have sadaqah, and then we have qardul hasan. Okay, so normally, okay, from zakat, okay, so zakat will promote financial inclusions, okay, by requiring the rich, okay, or the rich people or the wealthy people, okay, to give annual alms for those who are in needs, okay, or to asnaf basically, okay. So traditionally, it will direct transfer the goods or cash to the recipients, okay. Thus, the cash or goods will become the property to the recipient, okay. And then when they have the cash or the goods, it will allow them to participate in the economy in the moderate way. So this is how zakat help to for financial inclusion, okay. And then secondly, we have wakaf, okay. So on the same ground, wakaf is normally established for charitable purpose. Okay, so traditionally or previously, the wakaf, normally we can hear that wakaf is in the form of real estate, for example, land and building. Okay, so this asset is normally used for charitable purpose. Okay, so wakaf also actually can be used, okay, for more direct method if we want to relate it to the financial inclusion, okay, such as actually we can make a cash payment to the needy individuals from the proceed of the endowment. For example, people give an endowment, so the endowment can be given as a cash, okay, to the needy, or otherwise we can provide means, okay, for their livelihood, such as we give a land or livestock or equipment which are beneficiaries made, which will make the beneficiaries will participate in the economy, okay. And then the third one is sedekah. So sedekah basically they offer similar function as the zakat, okay. And then finally we have qardul hasan. So what is qardul hasan? Qardul hasan is interest-free loan, which means any financial institution, they may give financing to the needy people, but without any interest or without any profit rate. Okay, so this is basically Islamic social finance. Okay, so basically there are two roles that can be played by Islamic finance. The first one is through risk sharing contract, and second one through redistribution of the wealth, okay, which is through Islamic social finance. For example, zakat, wakaf, sedekah, and qardul hasan. Okay, now we move to the Islamic finance and financial inclusion Malaysian experience. Okay, okay, guys. I feel like I'm talking to myself. Can you hear me? Can you give some reaction to me? Can you hear me?
Yes, we can.
Okay, thank you so much. Okay, okay. Now we go to the Malaysian experience. Okay, so as we know, Malaysian can be considered as one of the leading, okay, in financial inclusion. Okay, so here, what I'm going to talk today, or what I'm going to share with you today, firstly, in terms of the barriers to financial inclusion in Malaysia. Okay, so first, to reach unserved population. Okay, so actually it might not easy for the supplier, okay, to cover every mile of the area in the country, okay, especially for the big country lah, okay. So normally a large part of unserved population in Malaysia is composed of the foreign workers and their families, okay. So this is because normally foreign workers, we don't have sometimes they are not registered, and then sometimes we have no record about them, okay. We don't have actual record on them, okay. And secondly, uh to ensure the people with access to financial services actually make active use of their accounts. So here it means that they may have account, but they may not make full use of their account. Okay, so the report have shown that many people are still use cash, okay, to settle their day-to-day payments despite of the availability of the modern payment. So moreover, there is still large number of employers who pay their workers salaries in cash. Okay, so number three, the barriers is to ensure that efforts to promote financial inclusion remain sustainable. I think this is the most challenges part which we want to make something sustainable lah. Okay, so in particular, the high level of household debt, whenever we want to give someone debt, okay, we would like to see their last performance, okay. So the high level of household debt is an important alert signal that should be monitored carefully, okay. We want to ensure, if we want to ensure the sustainable, we have to ensure that the previous borrower, they pay their debt, okay. Otherwise, we cannot maintain, okay, the development of financial inclusion. So basically, the barriers here is just the general barriers to financial inclusions in Malaysian cases. Okay. Meanwhile, I have also I've read in article. Okay, one article they have highlight the barriers. And then they have categorized the barriers or the challenges in terms of the supply side. Okay, so some of the challenges may include the high risk of the high risk of the and then high risk and high cost, okay, of the transactional cost, okay, and then the barriers in the communication, okay, and then lack of proof documents. So this is among the barriers that the financial institution they have to face, okay, in order to promote the financial inclusions. Okay, okay. Next, we go to the regulatory foundation. So this is all about the regulatory for from Malaysian perspective. Okay, so first we will look into the regulatory foundations. Malaysian Islamic Finance Regulatory Framework. So what are so special about Malaysian Islamic Finance Regulations? Okay, so as we know, Malaysian, they have a dual banking system, okay, which leverage both Islamic finance and conventional finance. Means that they are working side to side, the Islamic finance and the conventional finance. Okay, so here that is why Malaysian approach to the regulation of Islamic finance through they use